This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the December jobs report, which presented a mixed picture of a frozen U.S. labor market and how this immediately shifted expectations for the Federal Reserve's upcoming interest rate decisions. Links and resources are in the description below. If you find this podcast helpful, please consider subscribing to the channel for more market updates. So we have a really fascinating set of sources for this deep dive today. On the surface, the market is weak. It's not booming, but it's also just hanging in there. It's refusing to collapse. And that contradiction is really key. So we're tracking two big questions. Just how weak is the labor market really once you look under the hood? And what does all this mixed data mean for the Fed meeting later this month on January 28th?
These are absolutely the two levers controlling everything right now. The market, spent the whole back half of last year pricing in these aggressive early rate cuts.
Right.
And then this December jobs data just threw a wrench in the whole thing. It's a classic case where bad news just wasn't bad enough to make the Fed do anything.
Okay, let's dive right into those numbers then. The raw figures for December 2025, this is where all the confusion started. Analysts were expecting, about 73,000 jobs added, which is already pretty slow.
Yeah, and we came in way below that. Only 50,000 jobs were added in December. So that continues the downward trend. If the story stopped right there, it'd be simple. The labor market is cooling fast.
But it never stops there, does it? That weakness is sitting right next to two seemingly positive numbers. First, the unemployment rate. It actually fell.
Dropped from 4.6% down to 4.4%.
Which, usually the Fed loves to see. And then second, and this is the big one for inflation, wages.
Wages. They shot up to 3.8%.
Right, up from 3.5% the month before. So you've got this complete mess of signals.
Exactly. So when you look at those headlines together, low job ads but falling unemployment and rising wages, the immediate take is what we're calling that not terrible scenario.
Right.
It's not a soft landing. It's more like the economy is just stuck in a holding pattern. And this lack of a total collapse, that's the most important piece for the Fed. It gives them a reason to hesitate.
I want to push back on that a little bit, though. The Fed keeps telling us the unemployment rate is their North Star.
It is.
So if it drops to 4.4%, why do you still see this as a quiet erosion and not, a success?
Because you have to get past the headlines and look at the underlying structure. Okay, so let's unpack the hidden details, specifically the data revisions.
The revisions.
This is where that quiet erosion becomes, glaringly obvious. When the government puts out these initial job numbers, they almost always revise them later. And lately, those revisions have been brutal.
Okay, give us the specifics, because I think the scale of these misses really changes how you look at that new 50,000 number.
Let's take October. Initially, they said job losses of 105,000, already a big loss. But the final revised number was way, way worse, a loss of 173,000 jobs.
Wait, they missed the true number by almost 70,000 jobs? That's staggering. It's like a 70% error. What does that say about the 50,000 number we just got?
It says investor skepticism is probably warranted. We're looking at a system that consistently seems to overestimate strength up front and then quietly corrects the story months down the line. And it wasn't just October. November got revised down too by another 8,000 job losses.
So when you add all that past weakness to this sluggish 50,000 number, the story totally changes. We've been in a much weaker spot for months than we were told.
Exactly.
And that erosion is backed up if we zoom out to the annual numbers from the Challenger report, right? I mean, we're talking about huge preemptive cuts that companies made all through 2025.
Yes, exactly. Total job cuts in 2025 hit about 1.2 million. That's a 58% increase over 2024. This isn't just a hiring slowdown. It's aggressive cuts.
58%.
And if you look at where those cuts happened, it tells you even more about the pressures in the economy.
Okay, let's talk sector losses. The one that jumped off the page for me was government cuts.
Government cuts actually led the way. We're talking 308,167 cuts in 2025 alone.
Wow.
And get this. That's a 703% increase compared to the year before. The number of federal workers actually dropped by 9%.
700%. That number just changes the whole story about government jobs. That's not a small adjustment. It's a massive, rapid reversal.
It's a huge reversal. This is belt tightening at the federal level, but also at state and local levels as all that pandemic-era funding finally dries up.
So we're seeing a complete unwinding of that post-pandemic hiring boom.
We are. So while everyone's focused on tech, it's actually the government job market that's seeing the sharpest contraction right now.
So what else is driving the big job cut numbers?
Well, technology's still up there. 154,445 cuts. And that's really from two things. the big overhiring binge that went on, and critically, the adoption of artificial intelligence.
So AI isn't just a future thing, it's actually causing job losses right now.
These sources confirm it. It's happening now. And then finally, warehousing saw almost 95,000 cuts. That's from supply chains changing, consumer habits shifting, and again, more automation.
So we have these huge cuts happening in specific sectors, while at the same time, wages are growing at what looks like a solid 3.8%. But here's the painful part for the average person. You have to compare that 3.8% wage growth to inflation, which is estimated at around 6%.
Yeah, what's so fascinating is how the data can tell a story that looks good on paper. 3.8% is a solid number, but is completely hollowed out by purchasing power.
Can we clarify that 6% figure? Because headline inflation is lower, what does that 6% really represent?
That 6% represents the sticky parts of inflation. Things like services, rent, long-term contracts, the stuff that doesn't just go down when gas prices fall. The analyst consensus is that the true cost of living increase for most households is still hovering right around that 6% mark.
The implication is just stark. Americans are still falling further behind.
Precisely. Since real-world inflation is still outpacing wages by more than 2%, the interpretation is, well, depressingly accurate. The poor are getting poorer, and the middle class continues to shrink. That economic squeeze is still very, very real.
Okay, so this sets the stage perfectly for what the Fed is thinking. They look at this mess stagnation, big government cuts, real wage loss, but that unemployment rate is holding steady. How does that all translate into a strategy for their meeting on January 28th?
Well, because the jobs report was not terrible, it actively discourages them from cutting rates. The whole market was betting on a labor market collapse.
Right, something that would force their hand.
Exactly. Since the unemployment rate is stable, they feel they have no urgent reason to give up their inflation fight just to save the labor market.
And the market saw that immediately. Before the report, the odds of a January rate cut were already pretty low, I think 13.8%.
And after the report, they plummeted, down just 5.0%, according to the CME FedWatch tool. The message was loud and clear. January is off the table.
And the same thing happened for the March meeting too, right? The market just pushed all its expectations further down the road.
Absolutely. The odds of the Fed keeping rates the same in March jumped from around 59% to almost 69%. The Fed is watching one number above all others: unemployment. If it falls, like it did to 4.4%, they delay. If it starts to rise, then they'll think about cutting.
And that 4.4% number lines up perfectly with their own internal forecast.
It does. The Fed's projection is for the unemployment rate to end 2026 at exactly 4.4%.
So they're literally forecasting a full year of stagnation. No better, no worse.
That is their base case, a labor market that's neither booming nor busting for the entire year.
Okay, so if the data is stagnant and the Fed is signaling a delay, why did the stock market like the news? The S&P 500 went up, hit a new record high.
That's the great paradox of this whole market cycle, isn't it? The rally we're seeing is absolutely not being driven by a strong economy.
Or by the hope of Fed relief.
No, it's purely liquidity.
Okay, let's break that down. What does liquidity actually mean here? And why is it strong enough to make people ignore bad fundamentals?
When we talk about liquidity in this context, we mean the continuous cash injection from the Federal Reserve itself. So even though they've raised interest rates, the Fed is still cited as printing and injecting about $40 billion a month into the financial system.
And that money doesn't really go to Main Street, does it? It goes straight into financial assets.
It flows directly into financial assets. This is the very definition of financial asset inflation. You're seeing the market rise, not because companies are so healthy, but because there's just more and more money chasing the same pool of stocks.
So for a long-term investor, it almost feels like the game is rigged to the upside because of this.
That's the perception. Any little dip just gets seen as a buying opportunity because the central bank is implicitly backstopping the whole system with this cash flow. It creates a market that's really disconnected from the jobs report we've been talking about.
Which makes the Fed's official plan for 2026 feel, I don't know, almost irrelevant. They projected only one tiny quarter-point cut this year. But if liquidity is the real game, what could actually override that conservative plan?
And that gets us to the biggest political risk and opportunity on the horizon. The official plan is based on current leadership. But the market is already looking ahead to the nomination of a new Fed chair by the incoming administration.
A lot of listeners might wonder why one person, the Fed chair, can change so much when there are 12 voting members.
That's a great question. On paper, it looks democratic. But the chair has this enormous, unique influence. They set the agenda, they control the public messaging, and they're the one who builds consensus among all those other voting members.
So the market is anticipating a totally different philosophy.
That is the forward risk. The expectation, based on political commentary, is that a new chair would be much more aggressive with rate cuts. They'd prioritize growth and expansion over this current strict focus on inflation.
Meaning a new chair could just override these projections and start stimulating the economy much sooner than we think.
And that would just fuel asset inflation even more.
That is a critical signal for investors to keep an eye on. If the real economy is stagnating, but the money taps are open and politics are shifting toward more cuts, it forces a very specific kind of thinking. Many investors are thinking through what this means for their own positioning. If this raised a question or perspective for you, feel free to share it in the comments. Okay, before we wrap this deep dive, let's boil it down to the critical takeaways from this labor market freeze environment.
First, the Fed is laser-focused on the unemployment rate. So because that rate fell, rate cut odds for January dropped to just 5.0%. The labor market just wasn't weak enough to force their hand.
Second, the stagnation you see on the surface is hiding a quiet erosion underneath. You see the proof in those huge data revisions, like October's job losses being almost 70% worse than first reported. It suggests things are much softer than they seem.
Third, despite wage growth on paper, Americans are still losing purchasing power. That 3.8% wage growth is being eaten up by sticky inflation near 6%. The consumer is still under a lot of pressure.
And finally, the stock market's record highs are not about a strong economy. They're about liquidity from the Federal Reserve, that $40 billion a month in printing. And that disconnect is the key volatility driver for 2026. Thanks for listening to the 15-Minute Investor.